The topic for today is about the 5 phases of stock cycles. This is part 1. The purpose of this video is to explain to you which phase you should get in and which phase you should get out. Remember, the stock phases are man-made, the cycles are man-made. They are organized and led by the big guys. Why? Very easy. They need to maximize their profits, and they also need to create a constant stream of cash flows every day. They don't buy and hold. They buy and sell some, and buy some and sell some every day to create a stream of cash. As you can understand, it's a huge enterprise because it involves billions of dollars. So the big guys have to pool their resources together, and they have to divide the stock market into their own specialized territories so that they don't step on each other's toes. And they communicate constantly, they conspire, and they coordinate their actions because they know that they cannot undercut each other. If they undercut each other, how can they profit at the expense of the small guys? Now, these are the basic facts about the stock market that you have to understand. It's a zero-sum game. That means when one party gains, another party must lose. Big fish eat small fish. I hope you understand. Big guys have overwhelming advantages. I've talked about this many times before. The big guys have to initiate, and the small guys will be seduced to follow. This is very important. The price of a stock always leads the performance of the company by several months. There is a lead time. You have to understand this. The stock market is not casino gambling because you can predict with some certainty if you have the perspectives of time, space, and people. I've talked about this in a previous video. The price moves in repeated up and down cycles. And for established companies, the up and down cycle may last for a year or two. For small companies or penny stocks, it is very hard to tell because they fluctuate violently. The stock cycle can be easily understood if we think about the 5 price levels. These 5 price levels are represented by P1 through P5. I put in the value amount just to indicate to you the range can be very big, ranging from $3 to $70. These are by no means accurate, it's just an illustration. So let's start with P1. At this level, it's very low. The stock is oversold. The company is not dead, but at this low price, we know that the stock is oversold. At this price, the big guys are buying, the small guys panic sell. A lot of small guys sell the stock because they are afraid. They are in panic. And the stock is being purchased by the big guys quietly until it slowly reaches $20. This is the realistic low for the company. Now, at this price, the big guys will begin to push it up by buying some more. And when the price reaches $30, it is the public awareness price. That means the public is aware of this level. And the small guys begins to buy because everybody knows that this stock is good. And when it reaches 60, is a realistic high. The big guys begin to think about unloading it. But they may not unload because there is a higher price. which is P5, it may reach 70 or even higher. This is called the public euphoria level. The big guys are going to short sell the stock at this high level, and the many small guys continue to buy because they think that $70 is still low. It may reach 140 or 200. So at this high price level, the whole public is going crazy. Now, once we understand these 5 levels, we can think about the phases of a cycle. From P1 to P2, I call this phase 1. This is the phase where the stock is quietly being purchased by the big guys. I call this one the quiet accumulation phase. P2 to P4, this is phase 2. I call the noisy push-up phase. P4 to P5, phase 3, I call the euphoria phase. And now up to here, it cannot go further but down. So from P5 down to 5 is phase 4. I call it the quiet short sell and unloading phase. And when we reach the last phase, phase 5, this is the noisy depressing phase, because everybody can see that the stock is coming down and there is a rush out the door. So in view of all these, what should the small guys do? First of all, you have to be aware that the stock market is a game of money and power. It's not investment. You have to always remember that the stock price always leads the performance by several months. There's a lead time there. So if you base on the performance to buy a stock, you are using outdated data or irrelevant data. And when you look at the stock cycle, there are only 3 phases where you should go in. Phase 1, quiet accumulation phase. Phase 5, noisy depressing phase. And phase 2, this is more risky, noisy push-up phase. Now, if you go in phase 1 and 5, you need to buy and hold, because you need to wait for a little while before there is a turnaround. But if you buy in phase 2, noisy push-up phase, you have to ask yourself, when and where is the peak? Because if the peak is passed, or if you buy at the peak, you get out at a loss. Now, the stock cycles, being what they are for different companies, they seldom coincide with each other. So even though you can play in the 3 phases out of 5, you can still play all year round, simply because each stock cycle is different. They don't coincide, so you can play different stocks in different cycles. So there are always good opportunities all year round. In this way, it is advisable to keep track of a short list of the stocks that you want to buy, you want to play. And then you should be flexible to switch stocks whenever there's a need. In the next video, I'm going to talk about all the telltale signs of the 5 phases.